Now, let us look at the February 24th Investor Day comparison more carefully, because understanding what Dimon was actually referencing when he invoked 2005 through 2007 tells you something very important. It tells you about the timeline he was describing, and it tells you about the nature of the warning he was issuing. In 2005, the United States economy was growing at approximately 3% annually. The housing market was rising at double-digit annual rates. Credit standards and mortgage lending were deteriorating, but that deterioration was not yet visible in default statistics. Why? Because prices were still going up. Borrowers in distress could refinance rather than default. Bank profits were strong. Trading revenues were elevated. The financial press was focused on the equity market's performance and the optimism generated by economic growth. On the surface, everything looked fine. More than fine. It looked strong. But underneath that surface, a handful of people were looking at something different. A small number of hedge fund managers, some of whom later became the subjects of books and films, were analyzing the credit quality of mortgage-backed securities and concluding that the system was building toward a crisis that the surface-level data did not reveal. The crisis did not arrive in 2005. It did not arrive in 2006. It arrived in 2007 when Bear Stearns mortgage funds failed. And then it became catastrophic in 2008 when Lehman Brothers filed for bankruptcy. So when Dimon compared the current environment to 2005 through 2007, he was not saying the disaster had already arrived. He was saying something more uncomfortable. He was saying the system could be in the phase where the risks are already building, but the headline data still looks strong enough to make people dismiss them. The time between Dimon's 2005 parallel and the actual peak of the disaster was 3 years. That matters. The Street's analysis of Dimon's February 26th Investor Day comments noted this directly. The last time Dimon compared a market environment to 2005 through 2007, he was 3 years early. He was not wrong, he was early. And in finance, being early is often mistaken for being wrong until the cycle finally turns. He made that comparison on February 24th, 2026, 3 days before the Iran war began, 3 days before the macro environment that Moody's is now assigning a 49% recession probability to arrive in its current form. And Dimon said something else at that same Investor Day that received less coverage than the 2005 comparison. He said, "I do not know how long it is going to be great for everybody." Then he added, "I see a couple of people doing some dumb things. They are just doing dumb things to create net interest income." He did not name the institutions. He did not need to. The room understood exactly what he was describing. He was talking about the competitive dynamics of the lending market, a market where pressure on margins was pushing some institutions to weaken underwriting standards, a market where lenders were extending credit to borrowers who would not qualify under tighter conditions, a market where thinner covenants on leveraged loans were being accepted just to compete for deal flow. That is how a credit cycle begins. Not with panic, with comfort, not with collapse, with people doing dumb things because everyone else is making money. And Dimon said this while Jpmorgan was, in his own words, being quite cautious and sticking to its own rules. That is the architecture of the Dimon warning system. He is not calling a crash. He is describing a system where other people are making choices that will produce losses when the cycle turns. And he is saying Jpmorgan is deliberately choosing not to participate in those practices. That means Jpmorgan may not maximize profits in the current environment, but it also means Jpmorgan is positioning itself to survive and profit from the environment that follows. In the language of the competitive intelligence that runs underneath every Jpmorgan capital allocation decision, he is telling you something very clear. The bank knows what is coming, or at least it knows what kind of environment it must prepare for, and it is preparing at the expense of current quarter revenue. The April 14th earnings data confirms that preparation through the specific credit loss reserve dynamics. Jpmorgan's first quarter 2026 credit costs were $2.5 billion. Net charge-offs were $2.3 billion, essentially flat with the prior year. But inside the reserve dynamics is the number that tells you which direction the bank's models are pointing. Jpmorgan posted a net reserve build of $191 million in the quarter. Broken out by segment, that was a $327 million net build in wholesale, meaning commercial and institutional lending, and a $139 million net release in consumer. The wholesale build is the meaningful data point. Jpmorgan is adding to its reserves for potential losses on its corporate and institutional loan portfolio. It is not consuming reserves, it is building them. A bank builds loan loss reserves when its internal models conclude that the probability of future losses on its current portfolio has increased. That is the key. The bank does not build those reserves because it wants a scarier headline. It builds them because the model says future losses are more likely. And the specific environment driving the wholesale reserve build is the combination of energy prices and geopolitical risk. That environment has made the corporate credit landscape materially more uncertain than it was in the fourth quarter of 2025. The prior quarter's fourth quarter 2025 reserve build was $2.1 billion total. That reflected the immediate shock of the Iran war's onset. First quarter 2026's $191 million build is smaller in absolute terms. But it is occurring in a quarter when the war's immediate shock had already become the new normal. That distinction matters. By then, the bank's models had time to assess the war's second and third order effects on the corporate credit portfolio more carefully. A bank that was genuinely confident the worst was behind it would be releasing reserves, not building them. Jpmorgan is building them. Now, connect Dimon's preparation to the specific economic indicators that show whether the conditions he is preparing for are approaching or receding. Start with Moody's Analytics AI-based recession model. As of February 2026, before the Iran war had enough time to transmit through the economy's data releases, the model was already at 49%. That 49% reading was driven, in the words of Moody's chief economist, Mark Zandi, primarily by weak labor market numbers. He said almost all the economic data had turned soft since the end of last year. Zandi's more recent assessment, published in early April, introduced the vicious cycle index. That is a labor force adjusted version of the SOM rule, and it had begun flashing the signal that the United States economy may already be in a recession. The March payroll report showed 178,000 jobs added. On the surface, that looked strong, but Zandi noted that it followed a very weak February print, distorted by winter weather and a Kaiser Permanente labor strike. And without healthcare sector hiring, the underlying number was significantly weaker than the headline. That is how recession data often behaves before it becomes obvious. The headline looks usable, the internals look rotten, and by the time everyone agrees the downturn is already underway. Now add oil. Every United States recession since World War II, with the single exception of the 2020 pandemic downturn, was preceded by a spike in oil prices. Every single one. The 2020 pandemic downturn was different because it was caused by an external shock that shut down the economy through government mandate rather than through ordinary economic cycle dynamics. But outside that exception, the record is not ambiguous. The 1973 embargo, the 1979 Iranian Revolution, the 1990 Persian Gulf War, the 2008 financial crisis, which coincided with oil reaching $147 per barrel in July of that year. Each of those recessions had an oil price component that preceded the contraction. Oxford Economics published analysis during this conflict, stating that $140 per barrel is the specific threshold at which the global economy tips into mild recession. At that level, world GDP would be reduced by 0.7% by year-end, pushing the United Kingdom, the Eurozone, and Japan into contraction. Brent crude reached $117 during the current conflict and has remained consistently above $90 per barrel for the duration of the Hormuz closure. The IMF's April 26, 2026 World Economic Outlook, presented at the spring meetings in Washington, cut global growth projections to 3.1% for 2026. That was down 0.2 percentage points from January, and the cut was driven specifically by the Iran war's impact on energy markets and supply chains. But the IMF was explicit. The 3.1% forecast represented the optimistic scenario, the scenario where the conflict is short-lived, the scenario where oil prices average $82 per barrel for the year. The severe scenario is different. In the IMF's severe scenario, the conflict extends and energy prices remain elevated. Global growth falls to 2%, and 2% global growth is not a small adjustment. It is a level the IMF itself described as a close call for global recession. Against the IMF's traditional definition, 2% global growth means parts of the global economy are already in contraction. The regional breakdown confirms it. Middle East and Central Asia growth was downgraded by 2 full percentage points. Iran, Qatar, Iraq, Kuwait, and Bahrain were all projected to contract in 2026. Goldman Sachs, which had been one of the more optimistic major recession forecasters as recently as late 2025, raised its United States recession probability from 25% to 30% during the current conflict period. EY, Parthenon sits at 40%. Jpmorgan's own research arm, separate from Dimon's public statements, put the probability at 35% at the start of the year. That convergence matters. The last time there was this degree of agreement among major forecasting institutions, with recession probability above 25%, sustained for multiple months, was in the first half of 2022. That came after the initial Russian invasion of Ukraine and the commodity price shock it produced. Back then, the recession did not arrive. But the reasons it did not arrive are exactly why the comparison is dangerous today. In 2022, the Federal Reserve was able to tighten aggressively. Consumer balance sheets were still buffered by pandemic-era savings. Households absorbed the shock. Those specific conditions do not exist today. The pandemic savings buffer for the bottom 40% of income earners has been essentially consumed, according to Federal Reserve data. The Federal Reserve is not in a position to aggressively tighten without accelerating a contraction that may already be underway. And the oil shock is not a commodity price event that can be resolved through monetary policy in either direction. That is the trap. And that is why Dimon's preparation matters, because he is not reacting to one indicator. He is reacting to a convergence, a 49% Moody's recession model, oil above $90 per barrel, a closed Strait of Hormuz, a global growth downgrade, a Fed that cannot cut cleanly, a corporate credit portfolio that now requires more reserves, a market that still behaves as if the Fed put exists, and an investing public still looking at record profits as if the balance sheet is not warning them in plain sight. Here is the specific dilemma the Dimon protocol creates for the retail investor. Jpmorgan Chase is the largest bank in the United States by assets. It has $4.9 trillion on its balance sheet. It has $291 billion in common equity Tier 1 capital, a ratio of 14.3%. Giving it more capital buffer than any comparable institution. It has $1.5 trillion in cash and marketable securities. It has $572 billion in total loss-absorbing capacity. It has passed stress tests designed to measure survival through scenarios in which unemployment exceeds 10%, commercial real estate prices fall 40%, and stock prices fall 55%. In those stress scenarios, the Fed calculated that Jpmorgan would incur more than $64 billion in loan losses and still maintain a CET1 ratio of 9.8%. That is still considered healthy by regulatory standards. Jpmorgan will survive whatever comes next. That is not the question. The question is what Jpmorgan's preparation tells you about what it thinks is coming. It thinks risk-weighted assets need to be $60 billion higher than they were in the prior quarter. It thinks full-year net interest income will be $1.5 billion lower than previously projected. It thinks the wholesale credit portfolio requires additional reserve building even in a quarter when consumer net charge-offs are running flat. It thinks the market environment looks enough like 2005 through 2007 that its CEO used that specific comparison at the annual Investor Day on February 24th, 3 days before the Iran war began. It thinks stagflation is a live scenario for 2026, not a tail risk, not a disclaimer, but a named scenario placed into the April 6th shareholder letter alongside geopolitics, private credit risk, and global deficits as one of what Dimon called the larger risks, much like tectonic plates, always moving and periodically causing earthquakes and volcanoes when they crash into each other. It thinks the credit cycle, when it arrives, will produce losses that are worse than people expect relative to the economic environment in which that cycle occurs. These are not the opinions of an institution, reading the same data as the retail investor and arriving at the same conclusions. These are the outputs of the most sophisticated credit risk modeling apparatus in the American financial system, operating with information about commercial loan performance, corporate cash flows, consumer delinquency rates, and geopolitical economic scenarios that no individual investor has access to. When that apparatus produces a $60 billion RWA increase in a single quarter, a $1.5 billion NII guidance cut, and a wholesale reserve build that occurs at the same time consumer reserves are being released, it is the balance sheet equivalent of Dimon saying out loud what his risk models are telling him. The title of this video calls it the Diamond Exit. To be precise, Dimon is not exiting. He said at the February 24th Investor Day that he intends to stay as CEO for several more years and may continue afterward in a chairman role. Jpmorgan's stock was trading at $311 at the time of the first quarter earnings release, and the bank's return on equity of 19% and return on tangible common equity of 23% are not the metrics of an institution whose leadership is heading for the door. The exit is not Dimon leaving. The exit is what Jpmorgan is doing with its incremental capital, its marginal risk tolerance, and its guidance for the financial conditions it expects in the third and fourth quarters of 2026. It is exiting from the risk-on posture that produced record trading revenues in the first quarter by building reserves for the credit environment it expects to follow. It is exiting from the net interest income optimism of the fourth quarter guidance by cutting the NII forecast by $1.5 billion. It is exiting from comfort with the current level of risk-weighted assets by pointing specifically to energy price risk as the driver of a $60 billion RWA increase that has no obvious mechanism of reversal until the Strait of Hormuz reopens and oil prices structurally decline. The Diamond Exit is the institutional version of what every retail investor with an hour to study the first quarter earnings call transcript, would conclude if they read past the EPS beat headline to the guidance cut, the RWA increase, and the credit cycle warning delivered in consecutive paragraphs. Jpmorgan is not predicting a Monday crash, but Jpmorgan's balance sheet, read in full, is positioned for the scenario in which one arrives. The 49% Moody's recession probability is the institutional version of that same positioning. Before the Iran war began, the Moody's AI model was already at 49% based on soft labor market data and generally deteriorating economic conditions. The war added additional upward pressure. Mark Zandi said explicitly in the March 25th analysis that as oil steadily climbs above $100 per barrel and Iran rejects U.S. peace proposals, recession odds are only getting worse. The specific threshold Zandi identified as the historic tripwire is 50%. The model has never exceeded 50% without a recession following within 12 months. It sat at 49% before the war began. The war added pressure. The current reading reflects a ceasefire that the market treats as a de-escalation signal, while the strait is still closed and the Iranian foreign minister is visiting Islamabad without meeting the American negotiating team. If the ceasefire holds and a deal is reached, the scenario changes. Oil falls, inflation expectations moderate, the Fed gets room to cut, consumer sentiment recovers, and the indicators that are flashing, recession probability reduce. That scenario is possible. The market's rally on peace talk hopes reflects a meaningful market-assigned probability to it. If the ceasefire breaks, or if the Islamabad talks collapse without a framework, or if the strait remains effectively closed through May and June, and second quarter 2026 GDP data arrives showing the energy shock transmitted fully into consumer spending, then the 49% goes to 50%. And the historical record of what follows 50% is what every risk manager at every major financial institution running a portfolio is reading. The fortress balance sheet that Dimon has spent 2 decades building at Jpmorgan is a physical expression of his view that the world will periodically produce conditions worse than markets expect. The institution that survives those conditions best will be the one that prepared most rigorously when preparation was inconvenient. The 14.3% CET1 ratio, the $572 billion in total loss-absorbing capacity, the $1.5 trillion in liquid assets, these are not the current quarter's profit drivers. They are the architecture of survival. They cost Jpmorgan current quarter earnings by sitting idle rather than being deployed into higher yielding but riskier assets. And their existence reveals as clearly as anything Dimon has said publicly what the institution that has most successfully navigated every major financial disruption since 2008 actually believes about the current environment. It believes the tectonic plates are moving. It believes the credit cycle is approaching, even if it cannot name the precise sector or trigger. It believes stagflation is a live scenario for 2026. It believes energy price risk has materially increased the risk embedded in its current book of business. And it believes that when losses come, they will be worse than people expect relative to the environment in which they arrive. Jamie Dimon is not secretly preparing for a massive Monday crash. He is openly preparing for the next credit cycle in a balance sheet that, if you know how to read it, says everything his public statements are carefully designed not to say explicitly. The reserve build is there. The RWA increase is there. The NII guidance cut is there. The 2005 through 2007 comparison is in the transcript. The stagflation warning is in the shareholder letter. The 49% recession probability is in the Moody's model. The history of what follows 50% is in every economics textbook. What Jpmorgan is doing is not a secret. It is in the earnings release. It is in the call transcript. It is in the shareholder letter. It is in the Investor Day presentation. The institution that Dimon has built over 20 years is the most transparent major bank in the world about its risk management posture precisely because transparency about preparation is itself a form of protection from the scenario it is preparing for. The question this Sunday morning is not whether Dimon sees what the data shows. He sees it before anyone else does. The question is whether the retail investor holding the same equities that Jpmorgan's trading desk made record profits from in first quarter 2026 has read the same balance sheet. $60 billion increase in RWA driven by energy prices and credit risk, a wholesale reserve build of $327 million in Q1, a shareholder letter that used the word stagflation, an investor day that compared the current market to 2005 through 2007, a credit cycle warning that losses will be worse than people expect, and 49% recession probability. That is the Dimon Protocol. Not a secret, not a prediction of Monday, a systematic, documented balance sheet level preparation for the scenario in which the thing that has preceded every American recession since World War II, a sustained oil price shock, does what it has always done. The tectonic plates are moving. Jpmorgan knows it. The balance sheet says, the question is whether you have read it.